The content of this podcast is for informational and educational purposes only. Nothing you hear today constitutes financial, investment, legal, or tax advice. Always consult qualified professionals before making decisions about your business.
Nvidia, the Lakers, and Berkshire Hathaway made some big moves this month, and what that can mean for your small business. Coming up on education. We're going to talk about Nvidia, the Lakers, and Berkshire Hathaway. Starting with Nvidia, we had $500 billion AI infrastructure announcement made. Nvidia has partnered with all of the large most of the large asset management platforms, the BlackRock, KKR, a handful of others, basically looking to expand their capacity for compute for most of their customers. And I don't want to get too far into the AI infrastructure partnership that's being developed here, but I do want to take a moment to see how that can be translated into your small business, particularly around if you have a customer base and you're trying to expand your footprint with them. What are some mechanisms that you can use, both in terms of financing, other types of promotional activity that can help, not just expand your reach with other customers, but also get, higher ticket items with your existing customers. So we're going to talk a little bit about that. But before going too far into that, we had the Lakers. Obviously, they had just sold last year for $10 billion, and now they've just been flipped again at $12.5 billion. So already a $2.5 billion increase in value, sold to Bob Iger and Jared Kushner. So that's going to be an interesting conversation that I want to talk to our company listeners, our business owner listeners, particularly around goodwill and how using that scarcity asset and where we can actually expand goodwill in terms of the valuation of your company. And then lastly, Berkshire Hathaway, it looks like they've just started deploying after sitting on cash for about the past year and a half, basically since Warren Buffett passed away. Finally making some strong moves, $40 billion deployed. We can talk a little bit about that in more detail, but for that conversation, I want to talk a little bit about how you're positioning your cash balances in terms of strategically keeping those reserves and when to deploy them. So all those items will be discussed here on today's episode. But going straight into it, we're going to talk about Nvidia. They've just made a strong move. Obviously been a stock market darling over the past few years, and these announcements just seem to be coming on a quarterly basis now. Some large project that they're doing and partnering with large financial firms, different types of tech companies. But this one, $500 billion, to just basically expand their AI infrastructure and get more compute into the hands of their customers. And the main thing was that they're not lowering the price of their chips to accomplish this. This is a way of being able to expand their market share even further and get their chips into the hands of more of their customers and in the compute that's being created out of their chips without actually having to move on price. But it's a way to by having these assets basically as investable assets, as compute is. That's what Jensen Huang is really getting at, is these are revenue generating resources, compute in these chips, and as a result, they're financeable. There's somewhat of a predictable cash flow that's coming from it. And so that's how you're having some of these large institutional financial firms getting comfortable with the idea of actually again, not just with data centers, but also with this new financial rollout of getting this AI infrastructure out. But without getting too far into the nitty gritty of AI infrastructure, I do want to take really just use this headline as really a moment of what's your own version of being able to roll out financing or some other means to help distribute without lowering your costs, being able to distribute your services or your product in a way that can expand your customer footprint or get larger ticket sizes from your existing customers. And so obviously one of the main ones that you're probably familiar with, but third-party financing, for example, if you're, for example, an HVAC company and you don't currently have partnership with a third-party financer, it's probably a good call to actually start making tomorrow to try to look at some of those options. If you're approaching a prospective customer with we're talking a $15,000 ticket size, how much money you're potentially leaving on the door by not having payment option available to those customers or potential customers. If you're in the weather right now here in Pittsburgh, it can get hot, but I know, for example, back in May, we were still dealing with, we're getting into the summer and still 60-degree temperatures. Well, if your unit breaks down, you're probably going to, if you're on that cusp, it's like, well, the heat hasn't hit in yet. I can maybe put this off another month or two before making the payment. Well, why are they making that? Why do they have that reservation? Well, it's because, I don't have $15,000 to shell out right away. And so if the alternative to, getting your HVAC installed is, I need the check up front versus somebody, a competitor of yours that has a financing alternative where they can do, 12 months, 0% APR financing and, it's $1,000 a month, and then some change after, an intro 12-month period. Well, obviously, if I can pay for my unit for $1,000 a month for 15 months, I'd much rather do that than have to pony up that large check size right out the gate. So that's just one example, but several others. If you're a software vendor, not even a software vendor, but is there tiered pricing that I can provide? Increasingly you see this. What's very prominent right now is kind of like the bronze, silver, gold package, where the gold package is you have a very high markup, but maybe 5 to 10% of your customers may go that route. You have your middle of the road option, which the bulk of your customers are going to do that. And you have the very budget conscious option, which is void of a lot of the features. It might still provide give you some margin, but obviously for the very cost minded customers, it's a way to keep get them in the door without actually sacrificing too much of your margin. And then part of that's just kind of I would say negotiating tactic, but it's like these, they say at the restaurant, usually the highest margin, bottle of wine at a restaurant is the second cheapest option because no one's actually going to go for the cheapest. So they're always going to, still go for the cost effective option that's not the cheapest. And that ends up being the highest margin. So similar idea of, this tiered pricing is, can I offer a, really budget, budget service or budget product, the middle of the road one that's probably my sweet spot in terms of both margin and ability to produce that product or service on a level of scale, and then obviously a very well marked up premium version that adds a lot more features, adds a lot more whatever, and you may only be getting 5 to 10% of your customers, but it's almost again like a negotiation factor. You're anchoring a high price point to make the middle of the road price point seem that much more appealing, and it's usually you're not getting that premium option really. Again, maybe only 5% of your customers may actually go for that option if they desire, but a lot of times it's just like an anchoring tool to do that. But this all goes back down to pricing and ways where I can either distribute the cost or the price of a product or service in a way that is manageable to my customers. The other thing is pilot program. If it's a monthly service, maybe an introductory rate for the first month. Obviously, we see this with various types of phone apps or web apps. It's your first week is free, but we keep your card on file, and then you may forget to either cancel, but it'll be a ongoing subscription after that. But taking those types of principles and applying them to your business in a way that makes sense for what you're doing, obviously is going to make be the difference between getting that customer in the door and them just saying no entirely. So where are some what are some ways, or what are some things I can do to help minimize that friction that otherwise could just turn into a quick no, or no decision on purchasing decision. Those are some things that I want you to really think about as you think about your pricing. Think about do I have the right promotions? Do I have the right tiered pricing? Am I offering payment plans that enable a smoothing out of my larger ticket sized offerings? And if you can do that, and if you've seen yourself be in that predicament, you really take a moment to really think through what some of those options could be. Is there a way to space out the timing of a payment where, a $20,000 sale, like I want to get that. Am I, even if I can increment that sale, the conversion of that sale by 5%, that can be a huge meaningful number to your business. And you may be losing out on that if you're not finding a way to really smooth that ticket size or whatever over the course of, let's say 6 months to a year, or whatever, however the math might work. So a few questions to think through. What's stopping your most interested customers from saying yes right now? Again, if they're interested, they want to say yes. And so a lot of times the biggest reservation may be, the upfront cost. Sometimes it might be the timing or the commitment size, but identify, what is that, biggest friction point and the biggest, roadblock to getting that sale done. And what are some ways where I can, smooth that over? And again, could that be you're providing financing, providing a payment plan, providing maybe a lesser service at a lower price that gets them in the door to a potentially larger sales price, and just maybe the overall commitment. So think through that as you think about what some of your roadblocks might be to your potential customers. And then secondly, if you broke your highest ticket offer into smaller commitments, would more people start? So kind of as I've been discussing, using $15,000-$20,000 as a price point example. If you had something that was, if you're converting 10% of a marketing funnel to a $20,000 ticket size, it's like, well, if I were able to make that ticket size $5,000 over the course of 4 periods or 4 installments, could be quarterly, monthly, whatever, try to get that conversion from 10% to 15% or 20%, and obviously that's a huge, meaningful increase. So you need to be able to try to find that sweet spot. If you think your conversions are low, are they low because that's too much of a initial ticket size, and could reducing that upfront burden by spacing that out over time, could that be a way to help increase those sales? So example I give here, 12,000 annual contract closes less often than one, that's $1,000 a month. Disregarding time value of money, the total amount is the same. But again, the friction is completely different. It's a 12x, difference up front. And again, if you can smooth that out, it makes much more of a viable proposition to your prospective customers. And then lastly, is there a financing partner you could introduce between your customer and your price? So again, for the trade companies out there, I mentioned the HVAC, some of these companies that do, we see a lot, I think it has gotten a lot more prominent with, residential, renovations, or, the HVAC plumbing stuff, right, where there's a lot of third-party financial, companies that can help with financing these types of projects, where obviously, commercial budget, it's going to be a little different. They may have their own means of getting financing, but especially on the residential side and your residential contracting, obviously, interior home renovation, your multi-room model renovation, HVAC install, some of that stuff that can be, not many people have, the average person doesn't necessarily have, $20,000 sitting in their bank account that can, just write a check. Obviously, if you're wealthier and are doing these types of renovations, you may have some saved up, but ultimately, if you can reduce the friction by having these, partnering with these third-party financing providers, it can help. Again, it's really just about, getting conversion and reducing that upfront friction of cost, and doing things in a way that, can get that, conversion number higher, right? So it's certainly something to take a look at in terms of financing for projects you do. Obviously, it can vary from business to business. But moving on, the Lakers $12.5 billion sale. So, as I mentioned, they were just sold last year by the Bus family, Genie Bus, and gets sold to Bob Iger and Jared Kushner for $12.5 billion. So already had what we call that a 25% increase year over year. And again, these, you're not to get too far off, but with some of these sports franchises, kind of the model has always been, for an asset of its size, when you consider the underlying cash flows, they're actually, their intrinsic value, if you were to compare them to a generic company, usually doesn't make sense. It's a little bit changed a little bit since the increasingly large size of these TV contracts. But it used to be, like the NFL, for example, maybe as little as 10 years ago, this NFL franchise may not actually break even unless they make the playoffs, where at that point the ticket sales that they can sell and the additional broadcasting that they do can actually turn them into the black. But a lot of times these companies wouldn't actually generate profit, but because they're such scarce assets, their value still increases over time. But if going, like I said, back 10 years ago, a franchise could be worth $1 or $2 billion. Obviously, it's obviously going into the 10 billion plus range now. But you look at those companies, so like, well, if I looked at a stock that had a market cap of $2 billion, they're actually driving a lot of cash flow. Meanwhile, these franchises weren't. So it's entirely a goodwill asset in that respect, because it's really just the intrinsic scarcity of the fact that there's only, in the case of the NBA, 30 teams, in the case of the NFL, 32 teams, and outside of any potential expansion, there's only a set amount of teams, in each league. So it makes for, these, increasingly, price points that are driving up higher and higher, because the likelihood is, there's always going to be someone willing to pay bigger check after another couple of years. We just saw this in the instance here where, just within a year, you go from 10 billion to 12.5 billion, and seemingly nobody bats an eye, right? It's the Lakers. We know who they are. They're one of the most world-renowned sports franchises, not just in basketball, but globally, just an iconic brand. And, it's all pretty much derived from, goodwill asset just through to that scarcity. It's just that brand recognition that really can't be, replicated, anywhere else. There's only one Lakers. You're in one of the top 2-3 markets in the United States, which makes you one of the top markets in the world, and obviously has a global brand recognition. So the question is, let's take a step back. What actually is goodwill? Well, the goodwill is, it's the intangible asset that's the value of your company that's in excess of your assets. So in the instance of a field service company, you have your assets are typically just going to be your trucks or service vehicles, It might be, you might have some property, like if you're owner occupied as opposed to renting, but overall it's, you may have some equipment, some machinery and equipment and so forth. But, that's obviously just the value of your assets. And if you look at a asset purchase, that's what you're buying, right? And then everything in excess of that is, going to be your goodwill. So that's going to be your customer list, and really an acquiring company's conviction that that brand and that customer list that you build is going to be a enduring asset over the course of, when we take you over, when, the acquiring company takes you over. So it takes so how do I build that out, right? So, we talk a lot about, previous episodes and just on SCG Edge about, do I have customer contracts? Do I have establish my brand? If I were to ask, if I was a local company, if I ask somebody in that locality or in that city, have you heard of this company? Am I getting referred? Am I getting a strong amount of my leads through referrals, or am I having to just do paid advertising on Google AdWords and trying to get clicks onto my website through that and converting through that way? So a couple different ways to really describe it, but ultimately, the more your company is worth is going to be determined in part by how strong that brand identity is and how strong that customer base is. So if you're getting, so what are some signifiers or key things that are contributing to that? Like we had this, like I just mentioned, have customers heard of me, particularly within that scope. Obviously, if you're a residential contractor, have people heard of me? Have they given me good reviews? Obviously, Google reviews are now an easy way to see how good your reputation is. But ask somebody on the street, have they heard of you? And obviously, if you're in a more hyper specific type of trade, do people in that industry know who you are? That sort of thing. So these are aspects of goodwill that you have, and the stronger your goodwill is, obviously, the the more valuable your company is going to be. So a couple things to really consider is, as we talk about, franchise value, like I had mentioned, brand loyalty, so I was talking about these components, how long have my customers been with, when I did my first acquisition, a home services company out in the New York suburbs out in Westchester County, they did, we took over a home services company and it had a recurring customer base. And I think the average age had to have been, certainly it was probably about 7.5. In some cases we had, in our cohort, probably had 20+% of the company that had, or of the customers had been using this company for 10+ years. So, certainly what you like to see, you have a, long, historically active customer base. So if you have that loyalty of, core customer base that's, using you time in and time out for, whenever it is that they need, particular service, obviously speaks highly to the company compared to a company that's doing a lot of high churn. If we look at, if, we were doing an analysis on your company and we saw that, your customers are turning over year over year, and the average, life of a customer is only, a year long, when maybe you have some peers that, like I'd said, may have been using a company for a few years, obviously you'd be lower on the, brand loyalty. But, and again, are you getting referrals without getting asked? So like I just mentioned earlier, ask somebody on the street, are they familiar with you? That's your reputation in the market. And again, are you getting a lot of leads through referrals, or are they, just finding you through traditional marketing means? Is the customer experience consistent? And then lastly, what are people just talking about you, in general? So what we say here is, the story people tell when you're not in the room. So, are they thinking of you highly when you're not there to hear about it? Or is it something where, it doesn't necessarily even pass their mind, or, they have a negative reputation towards you? So all these things are components that, together will form some formulation of this goodwill that we talk about. So the other thing to keep in mind is, this isn't something that's built overnight. Obviously, take the instance of the Lakers, 34 years of consistent, experience, success. Obviously, a league that just increasingly got more prominent and more exposure over time. But these things aren't built out overnight. Obviously, that reputation is, needs to be built over an extended period of time, and in a way that, it's, what's that expression? It takes years to build a reputation, only a day to ruin it. So obviously you have to avoid, so much of this consistency is really just, avoiding those, steep downturns in reputation. And when you are, faced with a potential reputational risk, what's your response to that? Because ultimately that's what you're going to be judged by, is not just your quality of service, but your ability to handle mistakes when they happen. And that's ultimately what I find to be, a way to really keep a strong reputation. Is it's not just providing good service. Anybody can do that, but it's how are you correcting mistakes when things go wrong? And that's ultimately what's going to help create an enduring, goodwill, and raising that over time. And then lastly, Berkshire Hathaway, like I mentioned in the lead, $40 billion just this year. The market has been, pretty toppy. It seems like, at least that's what some of the sentiment is currently, where you typically have seen Berkshire under Warren Buffett's, stewardship has really looked at buying opportunities and down cycles. But what's interesting on this one is obviously there hasn't really been a down cycle in any meaningful way. So you have $40 billion being deployed, and it's for people that are value oriented. It's kind of quizzing, because obviously there hasn't been a huge correction in the market, and they're deploying capital anyway. And this is after having sat on it. It may have just been, we've been sitting on it for too long. Maybe this correction isn't happening anytime soon. So this cash is going to the market, but it's less about this timing of the market for Berkshire Hathaway. But I want to position this down towards our small business audience, and that is you as a small business, if you are in a position where you're growing cash reserves, what's your strategy when the time strikes? Obviously, multi-billion-dollar deployment of a financial institution is going to be much different than what your strategy is in your own market. But a lot of the principles can still apply. The thing is, you're not going to have to really worry about a potentially bloated stock market, or worried that you're buying in as something too high, because a lot of the companies in your realm that you're dealing with, and this is kind of going back to our conversation last week, is you're going to, what the edge that you have as a small business owner is that you're treading in a much different realm compared to the Berkshire Hathaways of the world that ultimately need to be able to deploy capital at some point. You have the option of sitting on it, but there's going to be opportunities that arise that are distinct and disjointed from the overall stock market, where those buying opportunities are going to come up to you. So maybe we talk about having a cash reserve for your company in case of a downturn. Let's say a competitor has a downturn and it turns into a really good acquisition opportunity for you. Is that something where you're well positioned to strike when the iron's hot and take advantage of that, versus just letting that your market share just kind of dwindle out, and you maybe capture some of that and it's being absorbed by multiple companies in that market? It's something that I want you to be really strategic about in terms of how you deploy capital, because a lot of the business owners, they may be generating earnings, and maybe that's just being used to. But for some of the small companies out there, you may be generating earnings and maybe you're using it to provide a nice lifestyle for yourself. But for if you're able to, if you're a company doing 500,000 EBIT, a million EBIT, are you retaining that and finding opportunities to really, take your business to the next level? Is there stuff you can be doing internally with that money, financing a new project, again, acquiring a competitor, things that you can be doing, and again, being strategic with it. A competitor becomes distressed, or there's a buying opportunity where you can act on it quickly, close quickly, and deploy quickly, so that you're able to grow and turn yourself from that $1 million EBITDA company to a $2 million EBITDA company, or that 2 million EBITDA company to a 4 million EBITDA company. There's so many things that you can do. And again, this is all kind of disjointed from the stock market. There might be some systemic things that happen overall. Obviously, if there's a big recession that's impacting all companies equally, more or less, those are going to be a little different. But again, if you're well positioned to handle that downturn, all of a sudden you're able to capture all that market share after some competitors fall out from that, and you don't want to be the one in that position either. Yeah, there's two kinds of cash. So there's the safety cash, the 60 to 90 days of your operating expenses that we talk about in terms of being able to survive that downturn. And then anything in excess of that is kind of your opportunity cash or strategic cash, strategic reserve. It's being used to do something. And it obviously may not be a big company acquisition, but it could be, a company is liquidating inventory and I can buy it for pennies on the dollar, and reposition that, do whatever with it. But you want to make sure that you have maybe real estate goes up for sale that is a nice location for us to move into. I want to bounce on that before anybody else can take on it. So couple different things to consider, but obviously you want to make sure that cash is available for both purposes and know when to deploy. So every business is going to be a little different, but ask yourself if what's the opportunity that needs to appear. If X opportunity appears, I'm going to do Y and execute. Without that, everything feels risky. So have a bit of a game plan. Situationally put yourself in a position where it's like, oh, there's a location I want to move into, or there's a place I want to expand into, a company I want to buy that's maybe it's not a competitor, it's just strategic. I want to move into this service offering. There's a company in that space that's up for sale. I can move quickly on it because I have the cash, and I'm not going to be as dependent on particular financing. Think of yourself as an investor when it comes to your cash position, and how I can be strategic with that when the right opportunities arise. So it shouldn't be you should have a game plan for it. You shouldn't necessarily be sitting for a year and a half, 2 years like Berkshire Hathaway to make the right move. But again, you want to be able to pounce on those options. Those can ultimately and usually be the most accretive things you can do for your company, is being able to strike on a distressed acquisition and be able to implement into your organization. So for this month's challenge, so review your cash position, define your floor. Again, that's 60 to 90 days operating expenses, and really think about, what's the opportunity that, I want to see that would make me open up that checkbook. So ideally I have, an excess of that, safety cash position, and, building up reserves, start with 100,000, 500,000, a million, depending on the scale of your company, where I can really, hit on something hard and get something done when that opportunity arises. Because, again, you're not operating in a, bloated stock market. You're operating in a realm where, businesses could trade from anywhere from 2 to 6 times EBITDA, and an acquisition opportunity comes up. You're not having to worry about some of these like really, bloated valuations in the stock market, where companies are sitting on, like Berkshire Hathaway, $40 billion to deploy, and, are sitting on it, not knowing where to go, and ultimately, maybe having to make a decision just to put the money in somewhere. Obviously you don't want to be hasty with that money, but you do want to make sure you have a game plan for it, find a way to deploy it, and just don't be, distributing to yourself. Obviously it makes for a nice lifestyle, but you can potentially 2x or 3x the size of your company if you're able to make these strategic decisions on a, couple year basis, couple year time horizon. So super important that you look for those types of opportunities. So to sum it all up, every business is going to be a little different. Pick the one that makes the most sense for you. You can apply it to all three, but easier buying, with the Nvidia example, can I remove the friction that keeps the customer from saying yes? Payment plans, phased delivery, financing partners, don't lower the price, lower the wall. Secondly, strong brand equity. You want to build the franchise value that shows up in a buyer's offer: loyalty, referrals, reputation, consistent experience, good reviews, the story that people tell about you. So, and again, also just mitigating those, downside, reputational risk. And then lastly, smarter cash deployment. Separate safety cash from opportunity cash to find your trigger in advance and move when the right opportunity appears. But yeah, take a moment, think through these levers, which ones, make the most sense for you and can be the most impactful. And, take a moment to ask yourself, which one would help move the needle for over the next 90 days? Do I need to be strengthening my cash position, positioning my brand equity? Maybe I'm, looking to sell. I really need to evaluate, strengthen my reputation, my equity, and my goodwill. And what are some things I can do to help, build that up before you're looking to sell? And then again, obviously from a sales standpoint, can I be, smoothing over and reducing these points of friction when it comes to selling? And are there some tools on the payment side where I can be doing that? So, payment plans, hopefully we take some lessons away from, some of these latest headlines, and, hopefully we can apply it to your business. And again, if you need any advice with your business, we're here at SCG Edge. And that's it for SCG Edge. And once again, thanks for listening. Hopefully you've had a good opportunity to listen through these headlines and see how they can make the most sense for your business.